So we discussed international taxation in the last class. The starting point of this problem is you need to understand if a domestic firm brings back earnings overseas, then this income has to be paid to multiple governments, the host government and home government, right? And we discussed this IDSI example. It's a Canada firm and it has a subsidiary in the UK. So if IDSI brings income from the UK, then UK is the host government for its subsidiary, and then the home government is Canada. And in this case, this firm has to pay income tax to both UK and Canada. And then we discussed this simple case, that is a domestic firm has a single foreign project. And we learned that, at least from the perspective of Canada tax policy, we know that if a Canadian firm brings income from overseas, then it has to pay taxes on this foreign income at the same rate as profits earned in Canada. And then a tax credit will be applied. The important result here is the tax credit is up to the amount of the Canadian tax liability. So this basically means if a firm pays overseas tax which is higher than its Canadian tax liabilities, then it will ultimately pay a higher tax. And if this firm, its overseas tax is lower than Canadian tax, in this case, the firm will get this full tax credit, but the full tax credit cannot completely offset its Canadian tax liability. So still, this firm will have to pay the difference in tax to Canadian government, right? So I know I'm talking about this in a very general way, but to understand this better, we could just go back to the last lecture. In that lecture, I gave you some numbers and I showed you exactly how this calculation would work. So today we talk about a more realistic and more complicated case. So now we assume the firm has multiple foreign projects or multiple foreign subsidiaries. And in this case, the firm can lower their taxes by pooling together their foreign income. So basically, if they pool together their foreign income, then the tax credit from their foreign income can offset with each other. So this sort of like this portfolio effect, right? In some foreign countries, you pay higher tax, and in some foreign countries, you pay lower tax. And then the difference in these taxes can offset with each other if you pool your incomes from these multiple countries. Okay, so to be more specific, under Canadian tax law, Canadian firms, they can use unused tax credit in high tax foreign countries to offset their Canadian tax liability on earnings from low tax foreign countries. So a important point here is you can see that this offsetting effect only exists in foreign incomes between high tax foreign countries and low tax foreign countries, right? So the result of such tax policy is if the domestic Canadian tax rate is larger than the combined tax rate on all foreign income, the firm will pay the same domestic tax rate. If the firm pay a higher combined tax rate on its foreign income, then the firm will ultimately pay this higher combined foreign tax rate. So basically, to make this clear, it's something like this. So you're basically compare the combined foreign tax rate, right? So if the combined foreign tax rate is larger than, let's say we're talking about a Canadian firm. So it's larger than Canadian tax rate. Then in this case, in the end, if the Canadian firm repatriates income from these foreign countries, then in the end, this Canadian firm will pay this higher foreign tax rate. And if the opposite happens, if the combined foreign tax rate is smaller than this domestic Canadian tax rate, then in this case, the firm will pay this Canadian tax rate. So basically, the firm will always pay the higher tax rate between the combined foreign tax rate and the domestic tax rate, right? Okay, so let's see a simple example. So let's say we have a Canadian firm and it has businesses in the US and Mexico. Let's say we have some fictional numbers. The US has a tax rate of 20%, and Mexico has a tax rate of 50%. And tax rate in Canada is in the middle, 30%. So now let's say the firm repatriates $300 million from the US and $100 million from Mexico. What is the tax rate on this combined foreign income? The second question, let's say the firm repatriates $100 million from the US and $300 million from Mexico. What is the tax rate on the combined foreign income? So let's see how this works. Oops. Okay, so in the first case, right, we have $300 million. Right, this is from the US. And then we have $100 million from Mexico. Right? And then we want to think about tax liabilities and tax credits. So for this $300 million income repatriated from the US, we can see that the US tax would be given by the US tax rate times the repatriated amount. So it should be $60 million. Right? $6 million. Now, what is the Canadian tax liability? Well, Canada has a tax rate of 30%, so it's 90, right? And now let's see Mexico. So Mexico is the host country. So the Mexico tax would be 50% times $100 million. So it should be 50. And then for Canada, it's 30%, which would be $30 million. So the tax liability in Canada is $30 million. Now let's think about how the tax credit and tax liabilities would work. So remember now the firm can pool together these foreign incomes, which means the tax credit and tax liabilities from these foreign incomes can also be pooled together, right? So if you look at this US income, then you can see that there is a net tax liability, right? It's $30 million. So let's say, okay, let's say this is positive $30 million, which means the firm owes Canadian government $30 million of tax. And now, if we look at the income from Mexico, you can see that there is a tax credit of $20 million, right? Because Mexico tax is $50 million and the Canadian tax is $30 million. Oh, sorry, I should say it's $20 million tax credit. And as we discussed, on foreign incomes, tax credit can be used to offset with each other, right? So you can see that the net liability and the net credit from Mexico would be able to offset with each other. So the final or the total net liability is $10 million. Right? Now we can calculate this firm's total tax. So this firm's total tax has actually three components, right? So a US tax of $60 million and a Mexico tax of $50 million. And it also owes Canada $10 million. So it's 120. And now you can see that the firm repatriates a total of $400 million and it has to pay $120 million. So you can see that the tax rate would be the amount of tax divided by the total income. So it's 30%. Right? So you can consider this as method one. We can have a simpler method. So let's see how a simpler method could work. So in the first method, we calculated tax credits for different countries, and then we pool together these tax credits, and then we can calculate the final net tax liability to Canada. But in the second method, we can just directly put together foreign incomes. So you can see that the total foreign income is $400 million. And what is the total foreign tax? So total foreign tax would be 60 plus 50, right? Oops. I closed the lecture notes, so I have to reopen it. Okay, let me go to the slide we were just looking at. Sorry about that. Okay, good. So total foreign tax would be $60 million in the US and $50 million in Mexico. So it's 110, right? Now, what is the total Canadian tax? Well, the total foreign income from two countries is 400, and Canada's tax rate is 30%, so it's 120. And then if you compare these two numbers, you can see that in the end, the firm will have this $110 of tax credit, and it still owes Canadian government $10 million. So in the end, the firm will have to pay $120 million, right? So again, the tax rate is 30%. And note that in the previous, note that in the previous page, we talked about this. If the Canadian tax rate is larger than the combined tax rate on all foreign income, then the firm pays the same domestic Canadian tax rate. So how can you see this? Okay, we can actually check the combined tax rate. So, okay, let me remove these extra lines. Okay, so we can combine. So we can calculate the combined tax rate. Note that the U.S. tax is 60, right? And the Mexico tax is 50. And the total foreign income is 400. So this gives us the combined tax rate of 27.5. Right? And you can see that this is smaller than the Canadian tax rate, smaller than 30%. So in the end, the firm has to pay 30%. Right? So basically, you can see that through this example, we can actually prove the result made here. Okay, now let's see the second example. It's pretty similar to the first one. You just have different numbers, right? So we can go faster in the second problem. So now the firm repatriates $100 million from the US and $300 million from Mexico. What is the tax rate on the combined foreign income? So let's first use the more convoluted method. So let's first calculate tax individually. So the U.S. tax would be $20 million, and the Canada tax liability would be 30. And for this 300 Mexico income, the Mexico tax would be 150 at 50% tax rate. And Canada's tax would be $90 million. So now we will have tax liability of $10 million in Canada for the 100 million US income. And then for the 300 million Mexico income, there would be tax credit, right? The tax credit would be $60 million. So in the end, there is some extra credit here, right? There's $50 million of extra credit. In this case, we know that this extra credit will just be wasted. So in this case, the total tax the firm pays would be 20 plus 150 divided by 300. So this would give us check, 42.5%. And you can see that this is more than 30%, right? So this verifies our claim here. That is, if the combined foreign tax rate is larger than domestic tax rate, then the firm will pay this higher combined foreign tax rate. Right? So you can see that in the end, the firm would pay this amount. And of course, instead of calculating tax credit for each income from each country, you can again pool together foreign income, right? So if you pool together foreign income, you can see that again, the total income would be the same, right? It's again $400 million. And total foreign tax, you know what? Let me call this TF, right? It's much easier for me. So the total foreign tax is 170. And then you can calculate the domestic tax liability is 120, right? Because it's just 400 times $30 million. And then you can see that the tax credit is larger than the tax liability in Canada, which means in the end, this extra credit will be wasted. So in the end, the firm will have to pay this higher combined foreign tax, right? So I basically made up this example. Particularly the reason is this example will help you to understand the lecture note contents. And it's also because the homework has a problem which is pretty similar to this one. So if you can do this one, then you can finish that one from the homework. Okay, so let's talk about the second topic about multiple foreign projects. So about multiple foreign projects, right? The first result is a domestic firm can pull together foreign income. And of course, you have to understand how to calculate the tax rate if a domestic firm actually pulls together these foreign incomes. And then the second result is if the foreign tax rate is less than the domestic tax rate, then the domestic firm will have the incentive to defer repatriation of foreign income. So there are at least two reasons. The first is deferring foreign income can lower the present value of the tax, right? So it basically means the time value of money, right? We learned if you repatriate, let's say if you repatriate $100 million back to Canada. Let's say Canada's tax rate is $30 million. So for simplicity, let's say you don't pay foreign tax. Now in this case, your tax would be $30 million, right? If repatriates this year. Let's say you defer this for 1 year. Now, after 1 year, you will repatriate the same $100 million back to Canada. Still, let's say your tax is $30 million, right? So if repatriates in the next year. But the benefit is the present value of this tax would be 30 divided by this discount rate, which will be smaller than 30, right? So just due to the time value of money, firms will have the incentive to defer repatriation of their foreign incomes. The second reason is it's due to potential policies. If the firm does not bring back its foreign incomes back to its domestic country, then it has the option, or it can have the benefit of getting a lower tax rate if it repatriates in the future. The reason is because sometimes government will have the so-called tax holidays. So it means that normally, if a firm repatriates its earnings back, then let's say the normal tax rate is 30%. But then maybe due to some new policies, the government says, okay, now we will give this 2-year window. If you can bring back your foreign income back to Canada within the next 2 years, we will only charge you 10%. Then firm will have the incentive to bring back their foreign income, right? Because now the income tax is much lower. But this has implications. This basically means firms, they understand this. So they will have the incentive to wait. They will wait for the next tax holiday, right? And it's also important to note that deferring repatriation of earnings is only or is more likely to be beneficial if the foreign tax rate is smaller, right? If the foreign tax rate is larger than this Canada tax rate, then you will always pay this higher foreign tax rate. Then there's no tax holiday for you, right? Okay. So for the first 3 sections, we based our discussion on the assumption that international capital markets are integrated. But in reality, international capital markets, they're segmented. So in this section, we will talk about why there are segmentation between capital markets across different countries and what's the implication from this segmentation. Okay, so the first reason for segmented international capital markets is firms, they have different access to different markets. This is actually very easy to understand. Just think about this. Let's say if you're okay, let's go back to this Yeti firm, right? So this firm is a firm in Canada. So let's imagine that this is a well-known firm in Canada. So this basically means potentially it will have a easy time to find financing domestically, right? And then let's say this firm wants to expand in the UK. And if this Canada firm wants to borrow from a UK bank to finance its operation in the UK, then let's say it just is not known in the UK. So in this case, you can imagine that potentially it will have some difficulty to obtain financing. Or even if it can obtain financing, then maybe the cost of capital will be quite high, right? So this basically means that it's the same firm, but it has better access to capital market in Canada, and it has worse access to capital market in the UK, right? So that's why, or that's the example that the same firm can have different access to different markets in different countries. So what's the solution to this differential access to markets? Well, we can use currency swaps. Currencies, so if you look at this name, right, it's called swap. Then this basically means in a currency swap, two parties or two firms, more specifically, right? Two firms, if they enter this currency swap, then they will agree to exchange coupon payments and principal payments in different currencies, right? So basically, currency swap means firms swapping different currencies. Okay, let's see how currency swap exactly works. Let's see a very simple example. So we have a US firm. Let's say this is, let's call it as firm A. And it wants to borrow $160 million of Brazilian real, so BRL, to enter Brazil market. And let's say A's borrowing rate is 10% in Brazil and 4% in the US. So you can see that here the firm has differential access to the market, right? Its cost of capital is much lower in the US. So potentially it's because it's more well known in the US and nobody in Brazil knows this firm. Okay, now we have the other firm. A Brazil firm, let's say this is firm B, wants to borrow $100 million to enter the US market. So B's debt cost of capital is 10% in the US and 5% in Brazil. And the exchange rate, let's say it's always 1.6 BRL per USD. So now we don't want to consider the impact of exchange rate. We just want to focus on this currency swap. So let's say firm A wants to borrow. So now we want to see how this currency swap would work. So basically firm A, right? Firm A should borrow the funds that firm B needs from a US bank, right? It's like firm A is helping firm B to borrow the funds because firm A has lower cost of capital in the US. And then firm B, which is a Brazilian firm, would borrow the funds that firm A needs in Brazil through a Brazilian bank. Then they will swap their loans, right? So it's like A would borrow this USD, right? Let's say USD from a US bank, right? This is a US bank. Of course, it would only pay 4%. And then firm B would borrow Brazilian real, BRL, from a Brazil bank, right? Oops. And the interest rate is only 5%. So after obtaining the debt, they would do the swap. What would happen is firm A would basically give, right? It would basically give the money it borrowed from the bank to firm B. And then firm B will give the Brazilian real to firm A. So this is essentially a swap, right? And additionally, you have to consider the interest payment. And what you can see here is because firm A has borrowed this U.S. debt from a U.S. bank, then it has to pay this 4% interest payment in USD. So in the currency swap, firm B also needs to give this 4% interest rate in USD to firm A. And similarly, firm B has borrowed from this Brazil bank and it has to pay this 5% interest payment. And firm A will also give this 5% interest payment in Brazil real to firm B. So the beauty of this currency swap is you can see that despite the fact the U.S. firm has a 10% interest rate in Brazil, and the Brazil firm has a 10% rate in the U.S., none of them is paying this 10%, right? So by using this swap, in the end, they are just paying this lower interest rate, right? 4% and 5%. Okay, the second reason for the segmented capital markets across countries is this country level distortions. So this is more true in developing countries, because in developing countries, most of these countries, they have capital controls and they have foreign exchange controls. And these controls will create barriers to international capital flows. And you can imagine that if there are barriers, then markets will be segmented, right? So these barriers are just like walls built around each country, right? So markets will naturally be segmented. Basically, these capital controls or these exchange controls, they're there to regulate or limit capital. Okay, let me go to this page. Okay, so these controls, they are there to regulate or limit capital inflows or outflows. This is very true. Say in Canada, right? If you want to exchange CAD to USD, then it's pretty easy, and I don't think there is some limitation. But in China, if you want to exchange Chinese yuan into USD, then there is a upper bound. Right? Annually, you can only exchange, I think it's 50,000 US dollars. Right? So this is kind of capital control imposed by the government. So it will naturally segment the market. And then we also have the case, maybe the government can limit domestic currencies freely converted into dollars. So this is the case I just mentioned in China. And there could be restriction who can hold financial securities. Okay. And due to these differences across countries, right, either because of politics or reasons or legal reasons, social reasons, or cultural reasons, then you can see that these distortions will make some country riskier. And if you think about the spirit of CAPM, it basically says that if there is higher systematic risk, then you should get better compensation, then there should be a higher risk premium. So this is also true for countries, right? If a country has larger distortions, then generally investors, they will require higher compensation, and there will be country-specific risk premium. So what this means is the interest rate on government bond in a country with distortions will reflect a risk premium for the possibility of default. That is, for a country with higher risk, naturally, the interest rate on the government bond is not risk-free rate. And this is different from our conventional assumptions, right? Because normally when we talk about risk-free rate, we can use the, let's say in the US, you could use the 3-month Treasury bill rate. And then you would consider that rate as risk-free rate. You can do this because we consider the US government bonds are almost free of default risk, right? It's the same in Canada, right? You can use Canada's T-bills as the risk-free rate because Canada government has a rating, right? So you consider it as being very safe, and the rate on the government bond would be the risk-free rate. But this is different from for a lot of countries with higher default risk. And a important implication of this, the covered interest rate parity will not hold exactly. So we learned before that, okay, you know what, okay, maybe it's better to open chapter 30 lecture note. So let me, okay, you know what, I'll just write this covered interest rate parity. So we know that F equals S times, so let's say we are thinking about Canada and US. It's 1 minus R CAD divided by 1 minus R USD, right? So this is the spot rate. This is the forward rate. And both are expressed in CAD per USD. And this is the so-called covered interest rate parity we learned in chapter 30, and we used it to determine the forward exchange rate. Importantly, when we derived covered interest parity, we assumed these two interest rates, the risk-free rate. So this basically means if one country, let's say we're not talking about Canada, let's say we're talking about Russia, right? Because Russia is a country with higher default risk. So if we consider Russia, then in this case, the covered interest rate will not hold. The reason is because the assumption of risk-free interest rate does not hold here, because this assumption is incorrect. Okay, now let's see a example here. So for July 27, 2009, the spot exchange rate between Russian rubles, or rubles, I think it's rubles, and US dollars was 30.9845 ruble per USD, and the 1 year forward exchange rate was 33.7382 ruble per USD. At the time, the yield on short-term Russian government bonds was about 11%, and the comparable 1 year yield on US Treasury security was 0.5%. Using the covered interest parity relationship, calculate the implied 1 year forward rate, and then compare this implied 1 year forward rate with the actual forward rate, and explain why the two rates differ. First, you can see that there is huge interest rate difference, right? So the Russian government bonds have a interest rate of 11%. It's much higher than the interest rate US Treasury securities. Potentially, you can see that this is because at that time, there was huge default risk for Russian government bonds. The first question says, calculate the implied 1 year forward rate. So why we are using the word implied? Well, because we have the actual forward rate, right? We have the actual forward rate here. And now you're asked to find out the 1 year forward rate implied by the covered interest parity relationship. So we would just use F equals S. So here the exchange rates are expressed in ruble per USD, which means we should use 1 plus the interest rate in Russia divided by the interest rate in USD. And we know the spot is 30.9845, and the interest rate in Russia is 11%, and the interest rate in the US is 0.5%. So this gives us a number of So this gives us a number of 34.2217. So this is the first question. It's pretty simple. You're just plugging numbers. And then for the second one, it says compare this implied rate with the actual rate. And you can see that the actual rate is about 33, right? So basically the implied rate is larger than the actual rate, right? So why do we see this? Well, it's because this number is large. This 11%, this interest rate contains the compensation for default risk, which means this 11% should be larger than the risk-free rate in Russia, right? And you can verify this. You can actually solve Russia's risk-free rate using the covered interest parity. So what you would do is you will use the actual forward exchange rate, right? And then you will use the spot and US rate and 1 plus the risk-free rate in Russia. And if you solve this, you can actually back out the risk-free rate in Russia, which would be, it's here, 9.432%. 9.432%. Obviously, this one is smaller compared with 11%. Again, this is because 11% contains the default risk premium. So obviously, if you use 11% to calculate the forward exchange rate, you will get a larger number, which is larger than the actual forward exchange rate, because 11% is not a risk-free rate. This also implies that if you use the actual forward exchange rate, you can back out the risk-free rate in Russia, right? Which is 9.432%. What's the implementation from this segmented financial markets? Well, so here, what you can see is if financial markets are segmented, then you can imagine that one country or one currency will have a higher rate of return than another country or another currency. And then a firm can actually exploit this kind of difference. So basically, the firm can set up the investment project in a high return country, and then the firm can raise money to finance this project in a low return country, right? Which means the firm can get higher return from its investment, and at the same time, it can enjoy this lower cost of capital from a low return country. Okay, now let's see this example here. So, Comaco Enterprises is a U.S. firm that is acquiring Xtapa, a firm in Mexico. So the acquisition will generate free cash flow by 21 million MXN, which is Mexican pesos, the first year. This amount is then expected to grow at a rate of 8% per year. The price of the investment is 525 million MXN, which is 52 million USD at the current exchange rate of 10 MSN per USD. And Comaco has determined that the appropriate WACC in Mexico is 20%, and its USD WACC is 9.5%. And we assume the US risk-free rate is 6%, and the Mexican risk-free rate is 9%. Now, what is the NPV of the Mexican acquisition? By first computing NPV in Mexico and converting the NPV in Mexico at the spot exchange rate back to US dollars, right? So this is essentially the method one we talked about in the last class when we value a foreign project, right? So you could first calculate foreign NPV and then do the currency conversion at the spot exchange rate. So this should be pretty easy because we know that the free cash flow in the first year would be $21 million. 21 million Mexico pesos or pesos. And then the growth rate is 8%. And we also have the cost of capital in Mexico. It's 12%. Right? So we have everything we need to value this project. So the NPV would be the cost plus the first year cash flow divided by the cost of capital minus the growth rate. And you will find out the NPV is 0, right? And if you have 0 NPV in MXN, even if you do the currency conversion, then the NPV is still 0, right? So it's 0 USD. Okay. Let's look at the second question. So what is the NPV of the Mexican acquisition by first converting cash flows to USD and then computing NPV in USD? We learned about this, right? We learned about this. This is the so-called method 2. You would first convert cash flows into domestic currency, and then you can value those cash flows using your domestic cost of capital and your growth rate, right? Okay, now let's see how this works. Let's first convert cash flows to USD. Note here, we don't have forward exchange rate, right? Because we know that if you want to convert future cash flows, you have to use forward exchange rate. So what we can do is we can use the covered interest rate parity, right? So let's find out the first year forward exchange rate, right? So it would be the spot rate times the interest rate in Mexico divided by the interest rate in the US. And the spot rate would be so what's the spot rate? Oh, it's 10, right? So it's 10. And the risk-free rate in Mexico is 9%. And then the rate in the US is 6%. So this will give us 10 times. So this will give us 10 times 1.0283. Note that the cash flow will last forever, right? It's a perpetuity. So now we only have the first year forward exchange rate. Obviously, we need to calculate all future forward exchange rate, right? So for F2, that is the second year's forward exchange rate, it's similar. And the only difference is you have to use this squared. So it becomes 10 times 1.0283 squared. And you can do the same thing with all future years. And in the end, you can find out the nth year, its forward exchange rate would be 10 times 1.0283 with exponential n, right? Okay, that's the forward exchange rate. And we have to think about how to convert the cash flow in MXN back to the cash flow in USD, right? So let's think about the timing here. So the CF1 would be, so the first cash flow would be 20 million divided by divided by F1, that is the forward exchange rate in 1 year. This will convert the cash from MXN back to USD. And this would be 21 divided by 10 and 1.0283. So let's see what is the amount here. So it's so it should be, because the lecture note is using a different format, so I cannot directly find out the answer here. Okay, here we have this number. Okay, good. So it's 2.0422. Yeah. And then we can calculate the CF2, right? So to calculate the CF2, you have to think that the cash flow growth at 8%, right? So it's 21 times 1 plus 8% divided by this forward exchange rate in the second year, right? So this will give us 2.0422 times 1 plus 0.5. Oops. So 1 plus 0.0503. And then you can do CF3, CF4, and the cash flow in the 5th year. And in the end, what you can find out is the first year cash flow in terms of USD would be given by this amount. And you can see that the cash flow will roughly increase by about 5% each year. Now, you might wonder, hey, why when we think about cash flow in MXN, its growth rate is 8%. But when we convert it back, then we get a growth rate almost 5%. Well, the reason is because the cash flows grow at 8% in Mexican pesos. However, when you convert Mexican pesos back to US dollars, this forward exchange rate, it also grows. You can see that if you compare the first year's forward exchange rate and the second year's forward exchange rate, you can see that roughly speaking, the forward exchange rate increases at almost 3% per year, right? To be more precise, it's 2.83% per year, right? So you can see that you have two offsetting forces. In Mexican pesos, cash flow increased at 8%. But the conversion rate, this forward exchange rate, also increases. It increases at almost 3%. So the total result is the cash flow will increase at about 5% per year in US dollars. Right? Or you could check the answer from the textbook, and basically you can see that you can express the forward exchange rate into this formula. It's a function of n here. N means nth year, right? So this n refers to nth year. And then because the cash flow increases at 8%, so this means the cash flow in nth year in Mexican pesos will be given by this numerator. And then you can convert this back to the USD using the forward exchange rate in nth year, that is using this number. And you will have a formula looking like this. So this basically means that for the first year, if n equals 1, cash flow would be 2.0422. And just from this, you can also see that the cash flow increases at almost 5%. So after getting these numbers, we can pretty much do the calculation, right? Because we have the first year cash flow, and we understand the growth rate in USD is almost 5%, and we also have the USD cost of capital at 7.5%. So if you do the valuation, you can find out, you can see that this is the first year cash flow in USD, and this is the cost of capital in the US, and this is the growth rate, and this is the cost of the project, and then you will get 30.18 million US dollars. Now, what's interesting here is these two methods give you different answers, right? The first method gives you a result of 0 USD. And this second gives you a result of 30.18. So why do you get a weird result like this? Well, the reason is because we discussed before that under the assumption that if the capital market is internationally integrated, then these two methods should give you the same result. This basically implies that if the capital markets are not internationally integrated, then these two methods will give you different result. So to be more specific, when you're using the first method to compute the net present value, the cost of capital you use is the cost of capital in Mexico, right? It's 12%. And when you're calculating the net present value in using the second method, the cost of capital you're using is the cost of capital in the US. So potentially you're getting different results because potentially you're having different or artificially high cost of capital in Mexico. Or maybe you're getting a very low cost of capital in the US, right? You can imagine that if you decrease this cost of capital in Mexico to 10%, then you will have a strictly positive NPV, right? And you can also imagine that if this cost of capital in the US increases to 10%, then this 30.18 million USD NPV will become smaller, right? So maybe in the end, if you adjust the cost of capital between these two countries, in the end, you can make sure these two NPVs under two methods will be the same. However, because potentially the capital markets between the US and Mexico, they are segmented, then you will get these large differences in the cost of capital. And this will give you different results when you're discounting cash flows using Mexican cost of capital or using the US cost of capital. Okay, I don't want you to get confused. Again, let me emphasize here. If you have an internationally integrated market, then these two methods should give you the same result. But if this assumption fails, then you can get different results with these two methods. Okay, that's for today's class.